I'm Sarah Borkson-Keeter with REIT.com, and joining me for this month's quick study of the REIT market is Brad Case, NAREIT Senior Vice President for Research and Industry Information. Welcome, Brad.
Thank you.
And how did REITs start off in January, and what trends are you seeing at this point?
It's been a very strong start to the year this year. REITs have gained more than 3.3% already. Mortgage rates are up nearly 6%. It's really a complete reversal of last year when REITs performed weakly relative to the broad stock market. If you look at how the broad stock market has done so far this year, it's down more than 3%. And in fact, small cap value stocks are down almost 6%. There were some commentators who were suggesting over the last few years that maybe REITs had lost some of their diversification benefits relative to the broad stock market, and certainly what we've seen over the past 9 months is refutes that argument. If you look at where REITs have at where the diversification benefits of REITs have come from for the past 20 plus years, REIT volatility is about the same as what REIT volatility was before the liquidity crisis, and really has been down to that level since later in 2009. So REIT risk-adjusted performance is very much the way we've seen on a long-term basis. And keep in mind the diversification benefits depend to a great extent on the correlation. Correlation between the REIT market and the broad stock market is only about 0.6. So a very strong diversification there. Even more so for mortgage rates. They have a correlation with the broad market of only about 0.45. And the correlation between equity REITs and mortgage REITs is only about 0.6. So the REIT market really does enable investors to get strong risk-adjusted returns and also bring down the volatility of their overall portfolio by taking advantage of those low correlations.
And would you say investors are as focused on interest rates as they have been for the previous few months?
It's hard to see evidence of that. I think on a long-term basis, there's a lot of thought that that interest rates are likely to increase slowly as the economy strengthens, but investors don't appear to be concerned about the effect that will have on REIT returns, and that makes perfect sense because what we've seen historically is the normal response of the market to an increase in interest rates is to say, well, tell me what's happening with the broader macroeconomy. And generally speaking, interest rates are rising because the macroeconomy is doing better. That is good news for real estate, and that tends to drive REIT stock prices upwards. And certainly, since about August of last year, the market's reaction to information about the macroeconomy and how that will affect interest rates has been very different from the way the market reacted from May until August of last year. So I think investors appear to be focused on the macroeconomic situation and not simply on interest rates. I think that's a very healthy development.
And are there any sectors in particular that are off to a good start this year?
If you look at the strongest performing sectors we've seen so far this year, they are the healthcare segment of the REIT industry and also the multifamily segment, apartments and manufactured housing communities. And those actually are two of the segments that performed weakest last year. So I think what's happening is investors are really looking for the pieces of the REIT market where they're most likely to find value on a long-term basis, and they're doing it by identifying segments that underperformed last year. And I think there was so much investor behavior last year that's difficult to reconcile with the macroeconomic situation that investors this year seem to be able to find value by taking advantage of the segments that performed weakest last year.
Thanks for joining us, Brad.
Sure.
And for more news and information about all things REIT, please visit REIT.com.